Afternoon, everyone. I'm Charles Payne, and this is Making Money. Okay, so you've been watching the network. This is the headline that's garnering all the attention today. Oh boy, here we go again. Wall Street executives and CEOs are warning. Listen, these sort of stories are frequent, particularly in bear markets, bull markets rather. They happen all the time, and really in bull markets where the experts miss the move of a lifetime. Still, these stories do reverberate on down days like today, and of course on down weeks. They sort of have a compounding effect. Essentially, a group of Wall Street executives are pointing out the obvious, that when it comes to things like valuations, this market is significantly overvalued, right? But it's also made a huge move. It's made an 83% move since 2022. And of course, what I thought was really interesting about all of this is that none of them in this article or any that I've heard is saying, hey, bail out of the market. Ted Pick, I think, had the most interesting thing to say. In other words, what he talked about here is like, hey, you read what he says. He's saying the market's going to be soft for a little bit. Deal with it because it's going to rally afterward. And I think that's the most important thing. Markets go up and down. He's not saying get out. In fact, he sounds very, very optimistic about next year. Of course, I've been frustrated with the narrowness of the rally. We've talked about this on this show for a couple of weeks now. This narrowness is really worried. And this has been among the worst I've ever seen. Now, according to Investec, there's been only one other time there was a session where on the NASDAQ, right, where you had more decliners, 2-to-1 decliners over advancers. And, well, that happened to be November 18, 2021, that red dot. What happened after that? Well, that was a day before the peak. And so the NASDAQ was down for the next 13 months, 36%. So it is a warning sign, right? I mean, there's some weakness in there, but I don't see that happening this time because I think the dynamics of the AI story require huge amounts of capital, a sense of urgency, and deployment, right? This is a huge story in the still early stages, all of which, of course, points to surging revenues and I think widening profit opportunities beyond the picks and shovels names. Today's session, of course, it's a classic sell on the news kind of vibe. Palantir was up initially after they reported. It's down a little bit. Spotify, again, phenomenal results. They couldn't have asked for better results. Both of those stocks are down. However, the ugly internals, I'm going to get back to that, do point to serious problems, right? This is where we were just about an hour ago. This is your factor. So everything is under pressure. And while it appeared that investors were ready to rotate out of mega caps, remember earlier this year in the summertime, it felt like we had rotation. We've now, over the last couple of weeks, seen more weakness in mega cap. Some of these nonprofit stocks have come down a lot. And you would have thought maybe that money would go into cyclical sectors. That really hasn't happened right now. It's either tech or the sidelines. However, it's amazing because at some point, some of these point to extraordinary opportunities, right? Right now, though, all the factors, as I mentioned, including quality, including value, are in the red. So I think the weakness will be short-lived. However, the buy and dips crew is champing at the bit, I guarantee you right now, despite all the talk of a bubble. There's one other chart I want to share with you. Urian Timmer, he's phenomenal. This is the latest chart he put out. And I think it's significant in the sense that he's making this analog from 1998 to 2002 to this rally here, right? The Chat GPT rally, I call it. And according to him, if everything goes the same, we'd be peaking toward the end of next year. It could actually be a lot longer than that, but this is just one of the analogs out there that I think people should look at.